Getting a mortgage approved doesn't have to feel like an impossible hurdle, but if you don't have the right financials ready, you could face delays or worse, a loan denial. I'm Robert Weinberg, and in this video, I'll walk you through the exact checklist you need to prepare your finances before applying for a mortgage. Whether you're a first-time buyer or refinancing, these steps will save you time, money, and stress. So stick around until the end for an expert tip that could help you secure a better loan offer. Credit scores matter to mortgage approval because they represent how likely you are to repay a loan based on your financial history. Each loan type has a different credit score minimum requirement. FHA only requires a 500 or higher credit score, but 580 or higher is needed if you want to put 3.5% down. Conventional has a minimum requirement of 620. VA loans have no minimum, but most lenders require 580 or greater. And jumbo loans require a 660, but 700 or greater is preferred. Here are some tips to help improve your credit score quickly before applying. Pay down your revolving debt as much as possible. Ensure all accounts are current and avoid any credit inquiries. A common question I get is, will checking my credit impact my score? Soft credit inquiries have no impact at all, and many times we can use and issue a pre-approval with just a soft credit check. Hard credit inquiries can lower your score, but only by a few points. And you have a shopping window where all inquiries in a specific time frame between 14 and 45 days are treated as one inquiry for scoring purposes, so you are able to shop around without being penalized. Income and employment verification. Lenders want to ensure that you can reliably repay the mortgage over time. Key documents you'll want to prepare are 2 years of W-2s and the most recent 30 days of pay stubs if you're an employee. And if you're self-employed, you'll want to have 1 to 2 years of tax returns. And for non-QM loans, 12 to 24 months of personal or business bank statements, along with profit and loss statements. Changing jobs just before or during the loan process can cause issues, especially if you're changing your compensation, like from a W-2 to a 1099. A common question is, what if I'm self-employed or work multiple jobs? Self-employed or multiple job workers generally need a 2-year history in order to use that income to qualify for a mortgage. Debt-to-income ratio. Lenders calculate your debt-to-income, or DTI, to help assess your ability to manage payments and determine your loan affordability. The calculation for DTI is total monthly debt minimum payments divided by gross monthly qualifying income. Conventional loans can go up to a 50% DTI, where FHA loans can go up to a 56.99% back-end DTI. And VA loans have no maximum and are based more on residual income. USDA loans have a maximum of 41% DTI, but can go higher with compensating factors. And non-QM or non-qualified mortgages can go up to 50 or even 55% DTI, depending on the specific loan program. Here are some strategies you can use to lower your DTI before applying for a mortgage. Pay off debt to reduce your obligations. Refinance high-interest loans to lower your monthly payments. Avoid taking on any new debts. There's a common myth that student loans disqualify you from getting a mortgage, but that couldn't be further from the truth. Lenders typically calculate your repayment for a student loan based on either the actual monthly payment on your credit report or a small percentage of the loan balance for deferred loans. Down payment and cash reserves. I want to clarify different down payment requirements. Conventional loans require between 3 and 5% down minimum, depending on the property type. FHA loans require 3.5% down minimum. VA, no money down. USDA, no money down. And jumbo loans generally require between 10 and 20% down payment. Having cash reserves can help strengthen your loan application because it ensures you can cover future mortgage payments in a financial emergency. This can be especially helpful to offset the impact of a high debt-to-income ratio or other risk factors. Here are some saving tips. Automate your savings into a designated account just for the purposes of home buying. Cut unnecessary expenses or contributions temporarily to be able to turbocharge your down payment fund. If you have trouble saving, explore down payment assistance programs, which can help cover the initial cost on an FHA or conventional loan. Can I use gift money for my down payment? Yes, many loan types allow gift funds for a down payment, but a gift letter will be required to verify that it's not a loan. Required documentation. Here's the required documentation you'll want to prepare to ensure a smooth process. If you're a W-2 employee, I recommend having the last 2 years of W-2 forms and pay stubs for the last 30 days from all jobs. If you're self-employed and going full doc, we'll need 1 to 2 years of your tax returns. And if you're using a non-QM or non-qualified mortgage, you'll want to prepare 12 to 24 months of bank statements and profit and loss statements for your business. For all loan types, we'll want to see the last 60 days of bank statements and investment account statements with all pages. And consistency in these financial records is crucial to show the underwriters that you have consistency in your finances. You'll also need to prepare your driver's license or proof of identity like a passport or government ID card. You should be able to gather these documents within 24 to 48 hours of starting your collaboration with a lender so they can best assist you. Can I submit everything digitally? Yes, you absolutely can. You can upload all your documents using a secure digital portal that your lender can give you access to. Pre-approval versus pre-qualification. Pre-qualification is just an initial estimate of what you may qualify for on stated information, whereas a pre-approval is a detailed verification of your entire financial picture, giving you a more defined borrowing limit. Pre-approval is much stronger, and in this market, it's a non-negotiable since it shows sellers you're serious in the home buying process and you've taken the time out to get financially vetted by your lender. Pre-approvals can last from 90 to 120 days depending on the lender, and can be updated with refreshed documentation and financial information if needed. Being financially prepared is the key to a smooth mortgage process. By organizing your credit, income, debt, and required documents up front, you'll not only speed up the approval process, but also improve your chances of securing the best mortgage terms. If you found this guide helpful, make sure to watch my next video on multifamily properties. Thanks for watching, and I'll see you on the next video.